Welcome back to F.A.C.E, my trading warrior brother, Peter Goodburn. How are you, buddy?
Great. Dale, can you hear me okay?
Yeah, loud and clear, Peter.
Perfect.
Welcome back. You want to share your screen? It's that green box.
Hey, Peter.
Yes,
Nice to
hello,
have you.
Steve. How are you doing?
Good. How have you been?
Yeah, pretty good, thanks. Yeah, despite lockdowns and things.
I hope healthy and everything all right, huh?
Everything's fine, thanks. Yeah, I mean, it's quite extraordinary, really, what's going on with this lockdown business, isn't it?
It
I mean, it just goes on and on.
What a way for Merkel to go out after, an outstanding career as a leader of Germany for this to.
I can tell you one thing in advance, Dale.
What?
As it happened with Thatcher, not that I'm comparing the two of them having to do with policies, right?
Yeah.
But people are really going to miss Merkel. A lot of people in Germany, and I know that because I have close ties with, a lot of people that live there. And
well, Peter lives there.
I know.
Oh, okay.
A lot of people are criticizing Merkel for, several things. But I can tell you in advance, seeing how how politics worldwide are moving and how the quality of politicians is evolving over the years, I can confidently tell you that people are going to miss Merkel.
Okay. All right. Well, I'm going to send you a poster of her to hang up in your trading for times that you miss her. So anyway, Peter, anyway, how long have we been having these conversations, you and I? I'm guessing 6 years.
Quite a few years now. Yeah, that's
6 years. So you know what? I want to talk about something that happened early on when I first started talking to you back then. And what stood out for me with you is that you had in my mind, almost like a crazy aggressive target in the S&Ps of 4,200. And this was like 2016, 2015, when we were in the 2000s. Yeah. And here we are, knocking on the door of that number. I know back then you thought that might be the completion of a generational bull market. I know things have changed. Things change day to day, let alone, 6 years ago. But 4,200 was your number. Congratulations on that call. You were the most aggressive, had the most bullish, aggressive wave count of anyone that I had interviewed during that time frame. And here we are manifesting it.
Yeah, thanks, Dale.
I think Dale, Peter has what you like to say. He works with a telescope.
Yeah,
right.
He does, and
not with a microscope.
More like.
Yeah. So 4,200 resonating in the market. Even saw that number bandied about on CNBC yesterday. Peter, Tom Lee, who gets a lot of coverage. That's his call for a high of around 4,200 in April. Check it out and see if he's a subscriber.
Tom Lee. Okay.
Yeah, he's been with a few different companies, but he's frequently interviewed and kind of a fund manager, I believe. But he said 4,200 in April, and I said Peter said that in 2016, 2015. So you want to start with the S&Ps? Here we are. Okay.
Well, I thought, I thought it would be good to revisit maybe that long-term count. I originally had 4,200, but I've upped it this year to 54.
Wow. By 2023. Okay.
Yeah, I think we've still got that 94-year cycle running, which is well, actually, let's have a look at the long-term Dow charts, because when we first started to talk about the Dow going to 40 to 42,000, anywhere there was a band of range between 39 something and 42 something. It was back in towards the end of 2015, and that's because we reached our upside objectives at the time, but we didn't see any commodities reach our upside objectives. So we realized that the entire movement up from the financial crisis lows was still running up as an expanding impulse pattern.
What does Shemitah mean? I saw that word on your
Shemitah.
Yeah.
Oh God! I mean, I did some analysis. Yeah, I did some analysis some way back. because I read a book while I was on holiday. It was called oh God, no.
Based on Hebrew?
Yes.
Okay, like
And
the Torah code?
that's right. And
Oh, wow. Okay.
and I started to get really interested in reading this book. And anyway, it was talking about cycles and stuff. So I came back and started to look at what the Shemitah was and how that really sort of played in. So you just saw that in one of my charts.
You curious cat, you.
Well, another time we can talk about that in more length. It was quite extremely interesting, and actually I'm fairly interested in knowing what's going on with that now, because the rabbi that talked about this and wrote this book, I'm sorry, I can't remember it offhand. It might come to me in a moment, but anyway.
Yeah, I think it was Cohen or something.
Cohen.
Yeah. Well, you could say Cohen, and that'd be a pretty good guess for a rabbi.
That's my pronunciation. But
yeah.
Coming back to the original idea of 42,000 Dow was this number was basically derived from this sequence here. It was the fact that we had a fifth wave extension from 1974 coming in. This was subdividing into 5 waves, and I simply found 2 fabulous fib price ratios which were converging. And I use fib price ratios in a quite dynamic way, probably not unlike anybody else is using, but over the test of time it really works. And what I did was I extended waves 1 to 4 because wave 5 was going to be an extended wave. You can actually extend waves 1 to 4 by 1.618. Now you can't use that ratio for anything else. So they're quite specific according to the pattern you're expecting. But if I just double click, you'll see this projection coming up. Yeah. So that's how we got to 41,000. And then it was just a simple case of trying to find a fib price ratio convergence by taking the 5-wave advance in the Dow. And I think what I did was I took a 61.8 correlation ratio like this. Yeah. So I took 1 to 3 multiplied by 61.8, add to 4. Mm-hmm. And you go like that. And can you see the top? If I toggle it a little bit, can you see the top?
Yes, got it.
And it's crossing the same number.
Triple fib price ratio convergence.
Yep.
Okay.
So that was how that was derived. Anyway, just a bit of background from that long-term range forecast that goes back 5 or 6 years. Anyway, the more subject, I mean, I know we're pressed for time, but I just thought I would kick off with what we're talking about, the S&P, because it's been quite an extraordinary run. And I have to say that in terms of my expectations, that is what we've experienced since March last year. It's done more than I thought, because in this first phase, even though we've got upside targets going higher, because generally speaking, when you get a major collapse like this going last year, normally if you're experiencing, now we've labeled this as a 4th wave low and a 5th wave up to our targets. Now, normally, if you're going to subdivide that, the normal procedure for an Elliott wave analyst would be to start extrapolating into an expanding 5-wave impulse pattern. By that, folks, I mean, a standard principle of expanding 5 waves, where the 3rd wave is generally the longest. This is the template. Right. Now, of course, you get variations to the thing. You can have 1st wave extensions and you can have 5th wave extensions, but around 85% of the time, you're going to see a 3rd wave extension. And if you're going to extrapolate such a pattern as the beginning of a 5th wave, it will take on this pretty much 85% of the time, it will take upon this pattern where the 3rd wave extends. And generally speaking, it would probably get close to reattempting a previous high like this, and it would find probably formidable resistance. Sometimes it breaks above slightly like this would. Yeah. And then you get a fairly sizable correction. We never saw that.
No, never happened.
No, and that's quite remarkable. Now, I think I know the reason why, because I mean, it's taken a little while for the penny to drop, but back in February, the penny did eventually drop because I started to look at the Russell and a few other US indices, and suddenly saw that this upswing, rather than being a 5-wave expanding impulse pattern, rather than having a 3rd wave extension or maybe even a 1st or a 5th, this was developing into a zigzag. Wow, a zigzag.
Ending diagonal too, Peter?
Well, the zigzag. So we have basically wave A here finishing.
Yeah.
a very small B wave, which is pretty, real time. That's pretty impossible to predict. I mean, you wouldn't be able to do that. I think, no, it wouldn't be obvious. You would normally be thinking such an amplitude move would be tucked into the ongoing sequence of a 5-way pattern, which is what I thought at the time. But as it turns out, if we extend wave A by 61.8, hey presto, 41.28, we're coming into that number near, and this is wave C. So instead of actually moving up to begin intermediate wave 5, which is in terms of the secular bull uptrend, if we want to define that as beginning from the financial crisis lows, this should have developed into the beginning of a 5-wave impulse pattern, an expanding impulse pattern, but it's not. It's unfolded into a zigzag. The question is why? Why a zigzag? That doesn't make sense, unless, of course, it's part of a 5th wave, which is eventually going to unfold. I'll put this in red, as an ending diagonal. Now, that's the key issue here, and it actually resonates right through so many different indices and even commodities now that we're looking at. Because what's happened is, here we go. Here's the zigzag coming into fruition now, and of course, what we do know from diagonal patterns is that if they are ending diagonals, that is, they're either designated wave 5 or perhaps wave C of a broader zigzag pattern. That's certainly applicable to copper prices from the financial crisis lows. They should unfold, the impulse waves 1, 3, and 5, they should unfold into zigzags or multiples. By that I mean doubles or triples. Well, this is a single zigzag, fits the criteria perfectly.
Okay.
So the big
anything like this is the most aggressive. You've called for corrections before, but this is the most aggressive. Is it because it's an ending diagonal? And what do you think is going to be the catalyst? Yields are kind of taming down a little bit here. Everyone blamed the initial weakness in NASDAQ on rising yields. Any idea? I know you don't need to know what the catalyst would be, but I talked to you and you said you have just kind of a feeling of what's going on. Is it just it's going to be gravity and it's just due to happen, or do you have any inkling of what could do it? Could it be a 4th wave in COVID that a lot of people think is going to happen with the UK variant becoming dominant here in the US? Could that be it?
Well, when I was a blue button trading commodities back in the late 70s, when the managing director asked me what the hell's going on and why the price was going down, if we didn't know, we'd say more sellers than buyers.
Yeah, right.
I mean,
yeah, I know.
I mean,
you don't need to know. I know you don't need to know. The reporters will tell us after we're 20, 30.
Well, I mean, we've got to make an educational guess, haven't we? Because I mean, right. I think in earnest, it probably will be the fact that there's a bit of a whip up of fear mongering within governments.
Okay.
I don't know what the agenda is for these governments. I mean, that is an issue which I think merits another big discussion, because that does impact financial markets too. But my feeling is that here in Europe, they're really trying to put the trying to keep us bottled up here. And they're talking about another sort of lockdown, a 4th lockdown. I mean, we've been pretty restricted here since November, before the UK and before the US. And there's not much freedom of movement. There's been curfews at 8, 9 o'clock in the evening and so on.
Wow.
And I've seen people being
That's
stopped
when Europeans have dinner.
Well, that's right.
That's when they go out for dinner late.
That's
all
it,
right,
yeah. And it's pretty bad, really. So I don't know. We can guess that. The other thing is that I pulled up this chart, and I think this is fair to just show this one chart without copyright infringement. And it's
wow,
from Bank of America Merrill Lynch's global research their latest research, and they've basically put here an interesting chart which shows the annual global equity flows in terms of billions of dollars, and it's got $1.6 trillion. Look at this.
10 times as high as the previous.
I mean, you go back to 2002. I mean, it dwarfs it.
Nothing.
I mean, if that was an equity chart, that would be an exponential rise. The inevitable outcome of that is that all exponential rises, as you know, no no exceptions. All exponential rises of that magnitude always end up with basically a parabolic, which means a collapse. And I think that the money will suddenly dry up. So whatever money is being applied at the moment to the markets, I would say there's a pretty good reason for that to dry up suddenly, and that's going to send equities tumbling down pretty hard.
Okay.
So anyway, it's a bit of background there to consider. You might say, well, why does equity start to dry up? Well, there's not an infinite amount. I mean, obviously the Fed and other fiscal stimulus programs have started to pour in money into the markets.
Boy, is that going to be a great buying opportunity should this scenario manifest. You know, you could probably have a laundry list, but, you know, I want to move on to something that is debated, and I know what some of your long-term counts, I know that you're looking for this big inflation pop, Peter.
Yeah.
And, you know, that declines in commodities at different stages should be bought up. But what do you have to say to the people that are talking about the silver market, silver ending up being worth several $100s an ounce? So you're considering this more of a inflation pop than a commodity super cycle? Because that's what's being bandied around, is that we've entered a commodity super cycle. Are you on that page?
No, not at all. I mean, the inflation pop in my book, you know, we've been talking about the inflation pop, and we coined that phrase, you know, going back, I think 2010, 2011, when we first started to see, you know, the say goodbye to the financial crisis lows, and we started to look at a sustainable run up, you know, induced by federal banks, you know, and reserve banks sort of piling quantitative easing into the monetary system. And that inflation pop came about because what we tried to do is reconcile what the stock markets, like the Dow, the long-term charts of the Dow were doing, and what commodity prices were doing. Silver's not a very good example for this. We'll come back to silver in a moment, but what I can show you is long-term copper prices. That's a pretty good example of what's going on. Now, if you remember what we showed earlier on the Dow, where the secular bull uptrend is unfolding from the financial crisis lows as a 5-wave pattern, then if you take a look at, say, something like copper, well, let's take a look at the very long term. This is going back to the Great Depression lows, 1932. It's 5-wave secular bull uptrend. Now, this is what I really call, a commodity super cycle, not from the financial crisis lows, but from back here. That officially ended, from an Elliott perspective at least, back in 2006 here, 2009. This is pre-financial crisis sell-off. So this 5-wave advance that goes back all the way to 1932 finishes here in this period, this time period. And the correction to that, now in Elliott wave terms, what Elliott himself said is that when a correction unfolds, it'll doubly retrace. He said often you'll see double retracement. What that means is that you'll get a partial decline, then you'll get a break to higher highs and a collapse afterwards. He didn't word it as an expanding flat pattern. Perhaps if he'd had more time to bring his theories together a bit more, he would have probably recognized that his double retracement rule was an expanding flat pattern. But in principle, what he also said was that the corrections normally fall back to wave 4 preceding degree. Well, you can see that we've had 2 attempts like that here. This is really good support in the future.
Yeah.
And of course, ironically, if you extend wave A of this expanding flat pattern by 38 and 61.8%, you're going to get into these numbers. So this is our long-term collapse target, but the B wave hasn't finished yet. It's going to break into new record highs. So this is not in per se a classical super cycle in commodities, because it's part of a B wave correction. It's a bit of what we call a fake out in terms of Elliott wave. I mean, we more or less put those 2 words together, fake out, in terms of a B wave that gets everybody excited because it breaks into new record highs.
It's an irregular B.
It's an irregular B. It's an irregular B, yes, exactly. And then, of course, later you'll get.
It needs to, you know, you got to mix some prunes in with that copper, so it's not irregular.
Yeah, prunes will do it normally. Yeah, that as much as everything else. But yeah, it will be. You will need your prunes during this decline. I can tell you, especially if you're long. But no, it's not a super cycle. So I wouldn't agree to that. But as in terms of inflation pop, we always knew that inflation was likely to start rearing its head, quite some years ago, because we could sense that commodities were going to get this big push. And it was also going to be partly due to the fact that we expected the dollar to collapse.
Yeah.
Now, we haven't seen a collapse yet per se. We've seen it decline, obviously, 2 years ago from 2017 into 2018. And then it rallied for 2 years. Now it's dropped again. Now it's rallying a bit today as well, or the last since January. But this is not what I would call collapse. That's going to come later, I think. I think once we've got a shorter term correction finishing, then that can happen. Now, in terms of copper prices, what I think is going to happen now is that we're probably going to get a drop like this over the next several months. And this is going to coincide with the declines that we've got in stock indices.
Okay. All right. All right. Okay. So, you touch a little bit on the Dixie, and I'm wondering, because back in 2000, when gold was trading about 200, they started calling gold, well, it doesn't work. It's an archaic relic. It's just a paperweight. And now I'm hearing the same things about VIX. The VIX is broken. I'm curious if you have any kind of chart on VIX that might have some type of roadmap for what may be this correction coming in the S&Ps. Do you chart it at all, Peter?
Well, I haven't got. I think I probably have. I don't tend to. Actually, personally, I don't.
It's
like
okay if you don't. I was just curious.
Yeah, I don't like the VIX as a timing indicator.
Okay.
It's
fine.
The amplitudes between that and the price action that you're actually trading. I mean, I know you can trade the VIX futures now. I mean, that's good. But I did some long-term stuff early this year as part of our. I'm just trying to find it actually. I think it's probably here somewhere. We can take a look at the long term. How about that?
Okay.
We'll just take a quick look at the long term. But UV, here we go. It should be here. Oh, volatility, UVW.
There it is.
Can you see it? Oh, yeah.
Yeah.
Okay. Let's have a quick look. Okay. Yeah. I mean, well, this is not real time. I don't know. What is it trading today? Do you know?
Around 18.
Okay, so about it's dropped down a little bit lower here. Well, that's understandable if the stock indices are trading up a little bit, but I think we're probably due for a little bit of a swing up like this. This was my idea before it starts to drop down like that.
Okay.
Anyway, that's just
all right. So nothing major. Yeah. Okay.
No,
all right.
No.
Yeah, nothing major. I have one request for just a quick look at gold. From Richard.
Yes. Let's take a look at gold.
And okay. I know you're not in the $50,000 an ounce camp or even the $5,000 an ounce camp.
No. I think that's unrealistic. I think that again, I mean, we've got. I mean, this is the very long term chart going back to 1932 again. This is a fifth wave, and a very standard, very ordinary 61.8 correlation ratio, 1 to 3 for wave 5, 61.8 of wave 5 comes in about 20. Between I think we've got two targets, 24.55 to 28.25, something like that. It's pretty modest, I would say.
Do commodities and stocks? I mean, I'd say what really makes news is your new count. On the upside of S&Ps plus this correction, do commodities in the market kind of have the same lifespan for this rally into 2023 or so?
Absolutely, yeah. I mean, I think once the inflation pop's finished, we're going to get, a bit like the scenario in the financial crisis. Once everything tops out, everything should top out within a month or two.
Okay, generational highs is what you're talking about.
Yes, I think most things, yeah.
And what's the number for your new revised upside target after the correction in the S&P? 54 what?
Yes.
5,400, I believe you had up there.
Yeah, it's 5,400. Yeah, 5,405. Yeah.
5,405. Okay.
Yeah. Again, this is this is again repeating over and over and over the same fib price ratios. You just got to, one of the most valuable recurring patterns. You just go 1 to 3, add to 5 like that, add to 4 like that.
Okay.
That's all you do. Did it with gold on the very long term from 1932, and doing it here.
Okay.
So here, gold, I think here's also roughly what we did. I mean, as you remember, we went bearish right into this time.
Recall it.
Yeah, we had a 38% retracement. So it comes down to about 1660. But I've recently updated in our short-term bi-weekly reports. If anybody wants to subscribe to that, I'd recommend it, because we do a lot of short-term work there. But the recent chart for the short-term work is a little bit of an upswing here. I'm trying to sell gold in the next day or two if it edges up a tiny bit more. I hope I don't miss it, because I see silver's already on a sell signal. But we should have one more drop down like this, maybe two. And the two downside targets, originally 1660 was here, which is a 38% extension below this level. So that's still a very important support level. But if it breaks it, I wouldn't mind betting that we actually get to 1598, which is a 61.8 extension below here. So do keep a lookout for that. The interesting thing about this is that if we get down to 1598, that will coincide with silver at $23, which is basis the gold silver ratio, which is currently trading about 69.4.
Yeah, it looks like it broke out over 68. That's gold silver ratio, but I don't want. We're close to time. I want to ask you. Sonny Gill would like to know, what's your time frame for this S&P correction? When do you think? I know you do some time stuff.
For the downswing. Well, I think we're likely to see a very sharp accelerative sell-off. It will still take several months, but of course, seasonally, if we're looking for a big sell-off like that, you've got to think about October time. Oh, I'm talking about the low in October.
Okay.
Are you talking about when does the market turn down? You mean right now?
Yeah.
Well, if it turns down,
Peter.
it should turn down within the next week, because one thing I would say is that we've already turned down in the Russell.
Okay.
Because if you take a look at the Russell, this is the Russell 2000, and there's a perfect zigzag here, A, B, and if you take 100% equality ratio between these two vertical upswings.
Yeah. You're talking about a 50% correction in Russell here.
Yeah,
and NASDAQ almost. So
yeah. You see what happens is the second wave in a diagonal is normally a 76% retracement.
Yeah. Okay.
The other thing is that we've had a sell signal yesterday because on this Russell, because we've seen a 5-wave drop from the high. But look at this 3-wave correction. If you just extend this by 61.8, bang.
Yeah.
Look where it came.
Another great presentation by you, Peter. If people are asking for all these different charts, but we don't have time because we'll run into the morning edge. What's the best way for people to check out your work? You want to show your
thanks,
website?
Dale. I get a plug. Well, everybody
this
listening,
is your commercial, buddy.
This is my. I'm hopeless at commercials, but if everybody's listening, this is the best report that you can ever buy. No joking aside.
Time runs out in 59 minutes. To get your last, you're almost out of issues because your printer's broken.
Okay, yeah, okay. Well, we've got a couple left. Don't you hate it when you get these things through your email box and it says last chance? If I ever see anybody say to me last chance, I just delete it because they always come back and say next to last chance. Buy here, buy that. Oh, for goodness sake, please. Look, we don't want to twist anybody's arm. We like to think that you have your own volition, your own purpose in how you're trading. Obviously, Elliott Wave is a very niche area, but it's very dynamic and it can really be of help. We're here to help you guys out there. If you want to subscribe, then we're here. You can send us emails and stuff after you subscribe, and we'll happily answer any questions. It's a real support thing, but we don't want to start force feeding anybody. I mean, it's got to be your own thing. So if you go to wavetrack.com, and you want to subscribe to our bi-weekly report, that's 2 reports per week. They're quite lengthy reports, but they're pretty good. You can view them as a PDF or online. You just go here to subscription, like this, And here's the Elliott wave compass, and you can just basically fill it out. It's $39 a month, so it shouldn't break any arms or legs.
You shouldn't be in the market if that's an issue.
Well, that's right. I mean, really, $39.
Anyway,
It's we're doing it really to, it doesn't really, it should be there to facilitate everybody's budget, and we think you'll get good value out of it no matter what you're doing. We do cover a lot of US indices, but also a few in Europe and Asia, and we also cover the currencies, about 5 or 6 currencies, Bitcoin as well, if anybody's listening, and of course things like the fixed income markets and gold, silver, and crude oil. So we didn't discuss crude oil today, actually. I mean, that's quite something. Crude oil.
Yeah.
I think crude oil is on its way down as well. Yeah.
I know. Peter, thank you so much again for sharing your work with us today, and hoping all your forecasts work out, or if they become alternate counts, that you reverse out in a timely manner. And always impressed by your work, and this kind of gives me a general framework for my shorter term stuff, looking at what you get through your telescope. And you know what, Steve said you use a telescope. You're not bad with a microscope either, buddy. So anyway, thank you, Peter, very much for being here, and I'll be in touch with you to get you your next date in the rotation. Okay, buddy?
Great, Dal. Thanks very much for today, and thanks for inviting me, and say hi to everybody that knows me, and hopefully, good luck with
Thank you very much, Peter. It was always
Steve.
a pleasure having you.
Lovely, Steve. Yeah, thanks to you too. Thanks a lot.
Have a wonderful rest of the day.
God bless you.
Steve, you have a beautiful, magnificent, tremendous day and evening. Not just the day, the evening too, bro.
There's no room for cherries on top, is there?
All right, everyone, that's a wrap. Remember, don't just count your pips, count your blessings. Join Steve and the team for the Morning Edge. You guys know how to find
10 minutes.
Peter. Yeah. Okay. And we'll see everyone tomorrow. Adios.
Bye-bye, everybody.
Cheerio. Bye-bye.